Oh my goodness, they're printing all this money. We're going to get inflation. And money supply has nothing to do with inflation. Milton Friedman was wrong about that. The Austrian school was wrong about that. The neo-Keynesians are wrong about that. Inflation is not caused by money printing. Inflation is caused by.
Today we have James Rickards, author of The New Great Depression, but let's dig right into it because a lot of you guys know who James is, and he writes a lot about macro economies, and I thought bringing him on would be a great way to get a little bit of different context on things to when you're reading headlines, how do you take it in. But let's start off with you're saying that we are in the new Great Depression. If you can explain that to us.
Sure. It's important to understand the distinction laying between a recession and a depression. A recession has a kind of a technical quantitative definition. It's two consecutive quarters of declining GDP. There are a few other bells and whistles involving employment and so forth, but it's a good rule of thumb. There's actually a body that determines that. It's the National Bureau of Economic Research in Cambridge. They call the Boston strikes on recessions. They tell you when it started, when it ended. They said that this recession began in February 2020. I think that's correct. But we can look at the data and see that it was over by probably July. Third quarter growth was very strong, not strong enough to get us out of the hole we had fallen into, but strong enough to end a recession. A depression is different. Depressions are much more long lasting, and people incorrectly assume that, gee, if a recession is 2 quarters of declining GDP, depression is worse. A depression must be 10 quarters of declining GDP, like a really long recession. And that's not the definition. You can have growth in a depression, but the point is it's depressed growth. In other words, it's growth below trend. For example, take the expansion from 10-year expansion from 2009 to 2019. The economy grew for 10 years. It was the longest expansion in US history, but it was also the weakest expansion in US history. Average annual growth was about 2.2%, and all recovery since 1980, average growth was 3.2%. So in other words, you were growing at a full percentage point less than the trend. And so it's that below trend growth, depressed growth relative to trend. That's what makes a depression. And that's what we're in now. So we had growth in the third quarter. That's fine. We'll probably have growth in the fourth quarter, although they keep revising the data downwards. So that target gets smaller. For the full year to 2020, it's going to be one of the weakest years, the largest negative growth, largest drop in GDP ever recorded. My view is we're in a second technical recession in the Depression. And by the way, this happened in the original Great Depression from 1929 to 19. There were two technical recessions. There was a recession from 1929 to 1933, very severe. And then there was growth. 1933 was one of the best years in the stock market, 34, 35, 36. We had growth. But the problem was we had dug such a deep hole that even with growth, you weren't back to where you were. So in 1934 or 35, unemployment fell from 25% to 14%. Then 1937, 38, we had a second recession. And that's what prolonged it and turned it into the Great Depression. We're going through something similar right now. We're going to have a recession in the first quarter of 2021, the quarter we're in right now. But this will be what they call back-to-back recession. We had, recession in pretty much the first half of 2020 and a new recession beginning in the first quarter, at least, of 2021, all in the context of a Great Depression. So I focus on the depression aspect of it. You can't have growth. You can't have declining unemployment. There are certainly investment opportunities, but you're looking at depressed growth. You're looking at a prolonged period of change behavior. We're not going to get back to normal or forget about normal. We'll live through it. We'll come out the other side, but things will be permanently different. And that affects all kinds of expectations about growth, asset allocation, and that's really what I focus on in the book.
What we're talking about today is more of a longer time horizon. So just to understand it correctly from my perspective, you're saying depression is, you can still have growth in a depression, but it's just not at the pace of 3%, 4%, 5%.
Correct. It's depressed growth, in other words.
1%, 2% a year over 5, 10 years, that can still be, in the technical term, a depression.
That's right. But again, you got to go back to the 2009, 2019 recovery, 10-year recovery, and I said growth was 2.2%. Trend growth prior to that, going back to 1980, was 3.2%. If you want to go back to the end of World War II, it was more like 4.2%. So that's the kind of growth. So you say, gee, 2.2, 3.2, it's only 1 percentage point. What's the big deal? No, 1 percentage point applied to a $20 trillion economy compounded over 10 years That adds up to $4 to $5 trillion in lost wealth. In other words, yeah, we had an expansion, but it would have been $4 trillion greater. There would have been $4 trillion more wealth created if we had been able to get back to 3.2%, at which we did not. The same thing is true today. Going back to 2020, first quarter GDP was down about 5%, second quarter down about 31%, and the third quarter it was up about 33%. Aren't we back where we started? The answer is no, because the 33% was applied to a much lower base. In other words, if you start the year at 100, say 2019 is your baseline, and just call it like 100% of 2019, you go down 5%, and then you go down 32%. Now you're around 67% of the old baseline. So even if you go up, let's say 30% or a little higher, 32%, that only gets you back to 87. It gets you 20 points. You get back to 87. You're still 13 percentage points below the old trend. Even if we have, say, 10% growth in the fourth quarter, that gets you another 8 points. You're still back to 95. We're not going to get back to 2019 employment levels in terms of total jobs until 2025 at the earliest. That's if nothing goes wrong in the meantime. But I expect a number of things will go wrong, including a new recession right now. A lot of people don't know, Lane. They know that the stock market peaked in October 1929 and it crashed 89.2% by 1932. So almost nine. That's what a real market crash looks like. And then you ask people, when did it get back to the 1929 level? When did it get back to the old high? People go, it must have been late 30s, early 40s. No, it was 1954. In other words, it took 25 years to get back to the old high. The Nikkei index in Japan hit 40,000 in 1989. It's still not there. That's, people talk about the lost decade. We'll try 3 lost decades. Here we are over 30 years later, and it's still nowhere near the old high. And so and I would say Japan's been in a depression the whole time. So that's what depressions look like. They're multi-year. They're actually intergenerational. You can have growth, but it's not trend growth, and it's not enough to overcome the damage that was done. So we're still way below, even with growth in the third and fourth quarters, we're still well below 2019 base, and we're not going to get to that level for several years at least.
So I think a lot of people understand this as if your stocks drop a bunch, where it's going to almost have to come up twice as much to get up to where you were, that phenomenon with numbers. And then you also mentioned what's going on in Japan, the lost decades. Do they have negative GDP growth, or is that kind of what you're alluding toward that the U.S. is going towards?
They have both. I think the U.S. is going to resemble Japan. I think it has resembled Japan since 2007, going back before the global financial crisis. But I think that will continue. So just to use Japan as an example, I said they're in a 30-year depression, which they are. They've had a series of technical recessions. Now, the recession might last 6 months, 9 months, a year, sometimes longer, and then they have growth, but they never get back to trend growth. They never get back to the old level. That's my point. Now, Japan's an interesting place. And I had a conversation with him. He was known in the 1980s as Mr. Yang. He was the assistant finance minister of Japan. But I was talking to him about this. So we're in Korea about exactly what we're discussing now, which is that Japan growth has been very weak, in and out of recession with a prolonged depression, but some growth along the way. And he said, yes, but you have to understand that the population is declining. So if you calculate Japan on a per capita basis, they're actually doing better than on an absolute basis. Absolute growth has been very weak, but if you spread that growth among a smaller population, the per capita numbers are actually significantly higher. That's just fifth grade math. So where you end up is one person owns the whole country and is the richest guy in the world. That's the reductio ad absurdum of what he was describing. He was technically correct, but that doesn't work in America. Our population is increasing. We're a country that likes growth. We like growth at the individual level and the national level. So the idea that we could be satisfied with weak growth and a declining population is just not going to happen. It could be in for a prolonged bout of weak growth. And then the policy question, how do you change that? How do you get out of that? How do you deal with it?
If you guys haven't heard of this term of changing world demographics, aging and birth, I think that was in Mr. Rickards' last book. If you guys want to check that out, but definitely a big impact. So America's population is growing.
Barely. It's funny. You look around, Japan's population is declining. Russia is declining. Europe is declining. China is flat, but they're approaching a level where they're not going to be at replacement levels. Of course, this is the legacy of the one-child policy, which was, we don't have to do a deep dive on that, but that was one of the great blunders of history, and aging rapidly. So Japan's flatlining now. Until recently, The United States population had been growing, not at a high rate, but faster than all those other countries I mentioned, mainly because of immigration. The natural birth rate of people in the country was not much better than Europe, at or slightly below replacement level. But we had enough immigration to increase population, but partly because of the policies during the Trump administration, that immigration has been truncated. So we may now be closer to a flat, shall we say, population growth. And of course, that affects output. There are lots of ways to think about GDP, the four-part definition: consumption, investment, government spending, and net exports. But there's an even simpler way to think about it, get to the same place, which is how many people are working and how productive are they? It's working population times productivity. Productivity has been flattish and not very strong for reasons that are not entirely well understood, but it's just the case. And population growth, here we're talking about the labor force, not the total number of people from coast to coast, but how many people are in the labor force. That labor force participation has been declining and fell very sharply during the technical recession that we had in 2020. If your population's declining and your productivity is declining, your GDP is not growing very much at all. That is the situation we're facing in the United States.
And also, like the way they keep those statistics on who unemployment has been changing to make it look rosier than it really is.
Yes, but I would say there's another statistic which is more important, which is the labor force participation rate, which is down around 61% now. But as recently as the 1990s, early 2000s, it was around 67%. So that's a the 6.5 point decline, or 10% decline if you think of it as a percentage of the whole. That's a big deal. That number is the lowest it has been since the 1970s, when women first started coming into the workforce in large numbers. Now, if you don't have a job, but you're not looking for a job, you're actually not counted as unemployed. Now it's around 7 or so, maybe slightly higher. That's still high, but it's a significant improvement over where it was last April, let's say. But that's not the number that matters. The number that matters is labor force participation. Tens of millions of Americans have left the workforce. And I'm talking ages 25 to 54. There are always some, but we're talking about able-bodied individuals between the ages of 25 and 54, prime working ages, who have left the workforce. If you're not banging on the door of the unemployment office looking for a job, they don't count you as unemployed, but you're not working and you're not producing. And so I look at that number because to me, it's a better gauge of economic growth.
Displayed right here. So that's just simply Googling the labor force participation rate kept up by the U.S. Bureau of Labor Statistics. And we know they're always just trying to sell news headlines, just like how they're talking about how elections are horrible, but I don't see any of that issue happening. They're
Right.
always saying that unemployment's down, but is this really the way to that noise?
Yeah, this is a more meaningful chart than the unemployment rate. Again, this is the labor force participation rate. Now, you notice you heard a lot of talk in last March, April, May about the V-shaped recovery and pent-up demand and all that. And you look at that chart and look at labor force participation, you see the steep decline at the time of the pandemic. Okay, got it. It came back, but that's not a V. It's a half a V. In other words, the bounce, now it's flat and going down again. So yeah, you had a little bit of a bounce back. That was to be expected after we got through the original round of lockdowns in May and June. So you had that bounce back, but then it flatlined and now it's going down again. And that's consistent with what I said earlier. You lock down half the economy, you're going to get a recession. It's as simple as that. And the other thing, Lane, is that people go, oh, the stock market's at all-time highs. There is a major disjoint, if you will, between the stock market indices and the health of the economy. But I look at the S&P 500, I call it the S&P 6, or maybe S&P 7 if you want to count Tesla now. In other words, the S&P 500 is a cap-weighted index. That means if you have a larger market capitalization, you count for more in the index itself. 40% of the index is about 7 stocks, and we know what they are. It's Amazon, Microsoft, Google, Facebook, Netflix, Apple, and now you can throw in Tesla and maybe 1 or 2 others. And they're the ones going up. They're the ones least affected by the pandemic. They're overwhelmingly digital. Amazon owns Whole Foods and Apple has some showroom type stores, but not much. Mostly they're online and they're selling digital products and advertising and data mining, et cetera. So they were not only unaffected by the pandemic, but did better because that was the only place people could shop or communicate. What about the S&P 490? What about the other stocks in the S&P 500? Have a look. The flat to down there. Yeah, there's some individual cases that have gone up, but on average, they're flat to down. So we've bet our whole economy on. So there's 6 or 7 stocks. So there's no relationship between how the stock market indices are doing and how the economy is doing. Who suffered the most and who continues to suffer the most? Small and medium-sized enterprises. So restaurants, bars, nail salons, dry cleaners, boutique shopping. There's a long list. And people look down their nose at that and they go, oh, you're a small business. Who cares? Or you're not Apple Computer, whatever. Those small businesses are 45% of GDP and 50% of all jobs. That's half the economy right there. If you crush it, you're going to crush the economy. I don't care where Apple stock goes. I'm not going to short it. It'll probably go up more, but you crushed and destroyed half the economy.
I want to go back to wrapping up the depression discussion. You mentioned productivity and the percent of labor force participation rate. What is the cause of that? I don't know if you can speculate. Maybe it doesn't matter, but what do you think is the general cause of that? Is people lazier these days, or?
No, I think there are a couple of causes. One is demographics. As I said, the population is aging and not expanding as fast as it used to. So that some of it's demographic. People get to retirement age. No reason you can't work at 68 years old. But the point being, that is a time when people retire and check out, then the workforce is going to decline and you don't have as many younger people entering the workforce. And millennials now, Gen Z is coming along, but not quite at that replacement level. But that's not the only factor. The other factor is because so many jobs have been moved to China and elsewhere, not just China, but China is probably the biggest culprit. Where are the mining jobs, the steel jobs, the assembly line jobs, the skilled craftspeople, et cetera? You don't need nothing wrong with college, but you don't need a college degree to work on assembly line. You need some training and some smarts, but those jobs are largely gone. And what are we replacing them with? We're replacing them with the gig economy, a barista, et cetera. And by the way, there's dignity in all work. There's nothing wrong with being a barista, good for you, or an Uber driver, but those jobs don't have the benefits and the pay scales and the security that we're talking about. So a lot of people just drop out of the workforce. Drug use is going up. Obesity is a problem. Diabetes is a problem. A lot of areas are just totally depressed. There aren't any jobs around. People don't have the resources to necessarily pick up and move. I remember in the 1980s, there was a migration from Detroit to Dallas. People just got a U-Haul and moved to Texas and got another job. That's harder to do now, not just a question of having the resources. There are plenty of jobs in Austin, but they're high-tech jobs. You do need an engineering degree or something like that to jump on board there. The quality of the jobs, the lost opportunities, the depressed area, drug addiction, demographics, all these things come together.
I've heard that there is immigration still coming into America, and that's a lot of the blue collar workforce coming in. And a lot of markets, there are new assembly plants opening up, Mazda and Huntsville, stuff like that. But I think it's more of a paradigm between the coastal markets and more southern, southeastern states, Florida. Is there a difference between people moving out of California or no jobs in California? I know homelessness is really bad out there in Washington and a lot of other cities.
When you talk about immigration, there are two completely different kinds of immigration going on. There's legal immigration with an H-1B visa or some other visas. And if you're an engineer from India, come on in. You'll get hired before you're off the plane. But that's a limited number. And those aren't really creating jobs for Americans. They're creating jobs for Indians who got an engineering degree. That's relatively small compared to the whole. Most of the immigration is the opposite. They're coming through the Mexican border. They're pretty much impoverished. And they're not all Mexicans, by the way. They're from Guatemala and El Salvador and Nicaragua and actually all over the world. If you can get to Mexico, you can probably get into the United States. Those people are not getting jobs in Huntsville. They're either dependent on the state or, landscaping jobs, waitress jobs, maybe babysitters, et cetera. And again, let me be clear, there's dignity in all work. I'm not disparaging people who do what they have to do for themselves or their families. What I'm saying is that those jobs do not have high salaries. They do not have benefits. They're not going to lead to high growth or higher consumption. Maybe in the next generation, that's fine, but not now. So we have the most recent data and it shows what I'm describing. There's a mass migration out of New York, Los Angeles, San Francisco, Seattle, Chicago, Philadelphia, and Baltimore, and a few other cities. And the people are going to Phoenix, Scottsdale, Miami, Nashville, Portsmouth, New Hampshire, Boulder, Colorado, Denver, and a few other places. And part of the reason is climate's nice, but there are jobs there, but the taxes and the crime. You didn't have the kind of rioting and destruction that you saw in New York, in Seattle, and Portland. There is this massive migration, which is interesting because in certain sectors, residential real estate is doing extremely well. Usually residential and commercial kind of move together based on interest rates and economic cycles. They can go up together or down together in a recession. But right now there's a bifurcation. Residential real estate in the destination cities and suburbs is going up very strongly.
You mentioned in your past book the move towards the urban exodus. I like that idea. That's like why we try and stay out of the city core, out to the more suburb, investing in those multifamilies out there.
Right.
And I think with pandemic, I don't know if you want to expand anymore. The big cities are mostly blue. Most people are moving out to the red states. Any other kind of newer developments on that?
I don't really get into politics. I would simply make the point that the reason commercial real estate is down across the board, even in stronger cities like Miami and Phoenix, that's suffering. And clearly the exodus cities, as I call them, New York and Seattle and others, are suffering even more. A lot of that has to do, some of it has to do with crime in the streets and the mayors and all that. Yes. But a lot of it has to do with the work from home environment, which very few large companies would have said 2 years ago, hey, I think everybody can work from home. We'll figure it out. Nobody was saying that. But in the pandemic and the shutdown last March, they had no choice. You had to work from home because of the lockdown. Turns out it worked pretty well. There are pros and cons. We all get a little tired of living on Zoom. A little personal contact is socializing is a good thing for your mental health. But that aside, from a purely business point of view, the work from home model still works. So if you had 10 floors of a midtown office building, prime location in New York, and they're vacant because everyone's working from home, you're not going to go back to 10 floors. You might go back to 2 floors. You might have a locker room, not like we had in high school, but yeah, a nice facility with attractive office space where people can basically reserve the office. So you're working from home, you call up, say, hey, I need an office and a conference room 2 days next week. And you book it, it's yours. You come in, you open your locker, there's a laptop and a sport coat and a tie or whatever you need, nice scarf, and you go sit in the office and you do your business. And then you go back and work from home. If that's the environment, it's not quite WeWorks in the sense that everyone's crammed in together. You could have a nice facility, but if it's always temporary and always rolling over, you only need 2 floors instead of 10 floors. So first of all, that slams the landlord, but the ripple effects are huge because it's not just that. It's okay. What about commutation? What about public transportation, food trucks, restaurants, cleaning staff, maintenance staff, shopping? It's all the things that surround people coming to cities and working in fairly dense environments. That's down 80%. And it's not coming back because the model's not coming back. We're a long way from the bottom. I understand what the stock market's doing. I would say, again, S&P 7, not the S&P 500, and query whether that's a bubble. I don't want to go short Tesla right now. You probably getting run over by an 18-wheeler. But in commercial real estate, small and medium-sized enterprises, including a lot of retail, which is half the economy, have been slammed.
They understand somewhere in the pile there is an emerging market out there. Any particular emerging markets in America that you like? Or
Yeah, as I said, we already talked about residential real estate in the target cities. So I would say, again, Nashville, Miami, Phoenix, and others as attractive. Again, we talked about residential real estate funds, but I think natural resources, water, agriculture, some other sectors will do fine. And there's also room for a big allocation to cash. And people go, wait a second, why would I want cash that has no yield? A couple of things. Number one, if you have deflation, and I think right now deflation is a greater danger than inflation.
most people, a lot of experts will say with the Fed printing all this money, it'll be leading towards inflation, right? $3 trillion, $4 trillion in the last few months, pop the stock market. And that's one of the ways it's shown its ugly head. But you're saying the complete opposite. It's deflation that's coming. Why is the whole inflation story not true?
First of all, it hasn't been true for 13 years. Go back to 2009. Between late 2008 and 2009, the Federal Reserve expanded its balance sheet from about $800 billion to something just under $4 trillion. So they increased it by 300%. And everyone's like, oh my goodness, they're printing all this money. We never got inflation. We didn't have inflation for 10 years. We still don't. And money supply has nothing to do with inflation. Milton Friedman was wrong about that. The Austrian school was wrong about that. The neo-Keynesians are wrong about that. Inflation is not caused by money printing. Inflation is caused by velocity of money. You can take the Fed balance sheet to 7 trillion. My friend Stephanie Kelton, she's the big brain of modern monetary theory. They say, why can't it be 10 trillion? The answer is it could be 10 trillion, but it's not necessarily inflationary unless you get the turnover. So I'll give you a simple example. Let's say I go out to dinner and I tip the waiter, and the waiter takes the tip money and takes a taxi or an Uber home, tips the driver, and then the driver takes the tip money and puts gas in his car. My $1 had velocity of 3. It supported $3 of goods and services, the restaurant tip, the taxi tip, and the gas. But what if I stayed home and watched TV? Then my money has velocity of zero. I didn't spend my money. There was no turnover. And I remind people, $7 trillion times zero is zero. In other words, if you don't have velocity, I don't care how much money you print. If you don't have velocity, you don't have an economy. Velocity has been dropping for 22 years. It started to drop in 1998, been coming down ever since. Now it had larger spikes down in the 2008 global financial crisis and the 2020 pandemic collapse. The clear line has been steeply down, and it's still going down. So my point is, and we need inflation. Inflation is not good in some ways, but you can't print your way out of a liquidity trap. You can't borrow your way out of a debt trap. The only way to get out of it is with inflation. And the only way to get inflation is to change the psychology, because it's not controlled by money supply. It's controlled by how people feel. And right now, their savings rates are sky high. It's cautionary savings. People feel the prices are going to get lower, so they defer consumption. Now, I'm talking about consumer price inflation, which is what the Fed looks at and what's policymakers look at. If you think the stock market is inflation, I can call it an asset bubble. Stock prices are going up. That's not inflation as economists and policymakers understand it. Those are just asset bubbles, and they are happening. So the money has to go somewhere. You got all these newbies who are on Robinhood. They're first-time investors. They don't really know what they're doing, but they know that stocks only go up. They're not spending the money. They're investing in the stock market. They're just inflating the bubble, not doing anything for the real economy, which would come from spending. And there's something to be said for savings, but that's what people are doing. They're saving the money and investing the money, so the money printing doesn't work.
Yeah, no, makes total sense. The money's out there. It's just the government needs to try and find a way to incentivize throwing it into the real economy, getting
Right.
that abundance mindset
Right.
for consumers.
That's right. And there is a way to do it, which I talk about in the conclusion of the books, not to tease it, but yeah, it's out there. What I tell people is that policymakers don't understand it. So I explain it clearly. I give two historical examples, two different presidents, one Democrat, one Republican in the 20th century, who pulled this off successfully. So it does work. There is historical precedent for it. Central bankers have forgotten it if they ever knew. So they should read my book because they want to know how to get inflation and get out of the debt trap. But the point I make for the reader is, even if the central banks don't do it, even if the government doesn't do it, you can personally go on a gold standard, go on a hard asset standard, and benefit personally, preserve wealth, and make money, even if the government doesn't find us. I barely talk about politics at all in the book, but partly for the reason you mentioned, which is it doesn't matter. Monetary policy doesn't work because of declining velocity. Fiscal policy, deficit spending, doesn't work because the debt to GDP ratio is so high that we're through the looking glass. That what people are doing now is they're saying, look, I don't know how it ends. It could be inflation. It could be higher taxes. It could be a debt default. There could be a number of different scenarios, but they're all bad. And so I'm just going to save more, spend less on a precautionary basis to get ready for that day when either inflation kicks in or I have to pay higher taxes or whatever. And that threshold, by the way, is 90% debt to GDP. Right now, the debt to GDP has gone up from 106% pre-COVID to around 130% today. So this is for the United States. The U.S. is now in the same league as Lebanon, Greece, Italy. There's your club. So my point being, we will have larger deficits. We will have more deficit spending. We will have more debt, but it doesn't work because we're through the looking glass. We're through that 90% critical threshold where now behavior changes and people don't spend the money. So monetary policy doesn't work because of velocity and psychology. Fiscal policy doesn't work because debt to GDP ratio is too high and people are getting ready for a bad ending. You can print money, but that's not stimulus. You can run deficits, but that's not stimulus. I always tell people, stop calling it stimulus. You can call it deficit spending if you want. You can call it money printing if you want, but it's not stimulus. It doesn't stimulate anything.
For the guy under a few $1 million net worth, what would you be suggesting at this point for their portfolio?
Yeah, there's room for residential real estate. We talked about that. You need the right fund manager, but there's a way to do that. Some for alternative investments, some money in some venture capital and startup type companies. They're risky, but they can be very attractive depending on the management again and the business plan. There's room for listed equities, but I wouldn't have more than about 20% or so in the stock market. People say to me, Jimmy, you've got 10% in gold. How can you sleep at night? And I go, you're 90% in equities. How can you sleep at night? That's really the risky asset class.
Yeah, that's something. I don't have any paper assets personally. We're always trying to move people to alternative assets. It's either do they take the money in their home equity or they take their glut of money in their stock holding, their mutual funds. And I'm like, I don't know. If it were me, I'd take it out of the stocks. But look, that's just, who knows? But thanks, James, for coming on. Folks, get his book, The New Great Depression, Winners and Losers in a Post-Pandemic World. Thanks for coming on. Appreciate it.